All right, well, 5 out of 5 days this week to the downside, and another 12-point range, and a ton more volume today than we've seen any of the other 4 days this week, following through on what we talked about last Friday and the market outlook video. So, big time week that's finally over with. Now what, right? So, with that in mind, that's what I'm going to break down in today's video. We've seen this story before, and I'm going to show you how and when and what that means and what we expect because of it, what technical signs this is showing with the extreme moves that we've seen, all of that I'm going to show in today's video. We're also going to talk about kind of the different other asset classes and how likely we are now to head into a recession, like with a death cross looming on the 15-200-day moving averages because of how extreme this week's move was. How likely are we now to really start headed towards like a 2007, 2008 type recession? So I'm going to show you that, and then today's trade idea, we're going to take a look at a stock and that might have some more room to the run to the downside no matter what the broad market does with its own technical patterns. So let's go ahead and get started. Today is Friday, February the 28th, 2020. This is the market outlook from marketscholars.com. My name is David Settle. All right, let's start off taking a look at the S&P 500 with the market forecast. So one day after getting a cluster, getting yesterday's cluster here, we came really close to another one today. In fact, we came all the way down to the 100% retracement level, just like that. All the way down to the 100% retracement, which is the low point over here, 28.55.94, October the 3rd, and we got to 28.55.84 today. So complete 100% retracement. We rallied off of that and finished at 29.54, so a 100-point rally off the low today. And actually went up even higher. If you look at SPY here, by the end of the day, in the after hours, it got all the way up to 299, so it went up another couple of bucks immediately after the market closed. So pretty good bullish move, getting almost all the way back up to 3,300. That was an important level that we were looking at before. The short-term sentiment bounced with this long lower shadow, a little bit of a long lower shadow on the weekly chart. When you can see, there we go, just a little bit of one. Well, here you have to get rid of all these drawings. There we go, a little bit of one, but not very much of one. Obviously, yellow line and light pink shading, and that's typically a bullish pattern, right? Now, granted, these were market sentiment pullbacks where you got dark pink shading. But yellow line, and if you go back further, you go back to all the way back to 2015 and 16, we had more of a bearish pullback here, kind of a couple of death cross environments. This was a death cross too when you got dark pink shading in the red line. But then look at all these other real significant pullbacks. October, that was the Ebola virus when we had big week of light pink shading and yellow line there. This was November of 2012. Here's June of 2012, light pink shading, yellow lines. This here was October or August of 2011. That turned into a death cross environment, which now it's more and more looking like that's what we're going to turn into here. Is eventually a death cross environment. You can notice over here we dropped significantly below 2 before bouncing back up. And then again, dark pink shading is when you get that death cross. When I say death cross, I'm talking about the cross over the 15 to 200-day moving averages, which obviously hasn't occurred yet. But and then you look at that's the weekly chart coming off of a lot of clusters and near-term peaks. In fact, if you look at this, if you look at the weekly chart, we came really close to getting a bullish pattern where you get the oversold momentum line, near-term line falling below 50. In fact, if you look at the monthly candle, we actually did. This is a bullish pattern on the monthly candle. Again, you can see the times. These are the death cross there, the death cross in 15 and 16. There's August right there at 15. Eventually getting the death cross at the end of 15, beginning of 16. Death cross there at the quarter 4. Over here in August 2011, we had a death cross there. So you can kind of see on the monthly market forecast the significance of light pink shading and yellow lines that turn into really bullish environments. Now over here, we got light pink shading, yellow line, and then that turned into by May, and this is where, I've talked before in our classes. This is when by June, by the time we rolled over in May and failed to get up and roll back down here, that's when you knew that we were in bear market territory. And of course the bear market over here too, by about May of '01, a little bit sooner, but about May of '01 we failed at the 200-day moving average, and then we rolled over in June and July, and then that was our bear market. So that's very similar. Obviously, we're not even getting light pink shading yet because the intermediate line's easily above. And every other time, and I'm talking about monthly charts here because we're done with February. Every other time that here was May of 2019, and the near-term line didn't fall, but you can see how bad of a month that was. We actually did hit an all-time high during the month before coming down. Over here, this was October of 16, and you can see that wasn't really a significant decline. That was just very small ranges that we had in August and September, and of course we had the election and we bounced off of that. The near-term line in October was also below 50, very similar to now. Here again you can see all these other periods in 2015, even in, because we had in August we had that long lower shadow, we didn't get the momentum line falling into the reversal zone. That's about as close as, in fact it dipped a little bit right there, and we bounced off of that. So you can see all these other times that we've dipped. This was a time here, May of 2012 again, where we did dip, similar to what we got now, pretty significant move. The near-term line had fallen below 50. The momentum line was down in oversold levels. And of course, here's August of 2011. By September, we had a yellow line and bounced off of that. So when you look at this actually looks really bullish heading into March. Whether we get a bullish March or not, by the end of the month, who knows? And I don't expect that we'll V-bottom off of this in the least bit. But there's a good opportunity that, the choppiness we do, if we do get choppiness, if we set the low point now with this, and we do end up getting some choppiness in March, there's a good chance that it ends up with a bullish bias by the end of March. So whether or not a new trend comes out I don't think a new trend will develop by the end of the month, but we could definitely finish up towards some previous highs by the end of the month. So you can kind of see that, when you look at it on the daily chart, it's about as bad as it can be. When you look at it on the weekly chart, that's pretty bad, but we've seen instances like this before. But when you look at it on a monthly chart, since this is a monthly, monthly candles ending today, it actually looks, if that were a daily chart, you would look to buy that dip, right? If this were a daily chart and you got that pattern right there, you would look to buy that dip. That's a bullish pattern. Now we've been bullish for a long time. This is, by the time we really got going on this intermediate run, you had light, dark green shading and green line. We were coming, this by 2011, we had that big dip below. By 2011, we've been bullish, which is always kind of interesting to say that the bull market started right here. The bull market really didn't start until over here, when the intermediate line crossed above 50, more about October of 2010, when QE2 started, and really by November. And then, of course, you had the credit downgrade, but then we took off, and that's really when the bull market started, and we've been going ever since. So that would be a little cause for concern about buying this dip. You wouldn't have, I wouldn't expect 4 years of rally coming off of this, or even 3 or 4 years. But, again, you never know with that either, because when you look at the monthly market forecast for the 10-year yield, which is getting a tremendous, a monthly chart, mind you, we've already got a cluster. We got another cluster here at extreme lows. Very similar. I mentioned before how similar we are now to right here, where we hit 2%, then we diverged down to 1.5%, and we got divergence. That set the low. It took a few months. That set the low point though, and we rallied. Well, here we go to 1.5, and then we diverge down to 1.25 or a little bit around there, and then boom. It might take a month or two, but I think this is kind of setting the low point here for yields, and potentially setting us up for a good bullish rally to come out of that. I've mentioned, a lot of people, I mentioned before that it's not a very recessionary pattern to see yields like this. To see yields like this is actually more of a pattern, again, similar to over here. This is the end of the financial crisis here. To see a pattern like that is actually it shows that we have been in a recessionary market. According to the bond market, we've been in a pretty deep, since October of 18, since January of 18, but then in bond market October, because inflation's lagging, commodities peaked in October or August, September, around there, and then yields peaked in October. Really, what these markets are saying is this has been a recessionary environment, right? It's been very bearish in a lot of global markets in the S&P, but this doesn't tell us we're headed towards one. This actually says that we have been in one, and the stock market hasn't necessarily complied. It's got very high valuations, but it kind of shows that that not only have our stocks extremely overvalued, but so are long-term bonds, which is not necessarily a sign of a frothy, excessively risk appetite market at all. Alright, so before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us here on YouTube. That will notify you when these videos are posted. Hit the thumbs up icon down below the video. That tells us two things. Number one, you liked our video today. And number two, you want us to do it again on Monday. So it's a quick way to give us feedback. We check those out to see what you're thinking, so let us know. You can do that right now. If you don't like our videos, if you don't want us to do it again next week, then don't have to click on anything. While you're down there, comment. What did you get out of our videos today? I always like to see your comments down there. Follow or join our website at marketscholars.com. There's a link popping out right there. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between these videos from day to day, and join our Market Outlook Facebook group that we've created. Alright, if you're watching us on our website, we invite you to check some of the stuff out that we have going on here. You can see I have my Q&A session for our premium subscribers. Those are the subscribers to our premium plan. We also have our link to our Market Outlook live video. We've already put on today's trade idea before the market closed during that particular video. I also check out old trades and manage them. Talk about when and how we close them. That's all part of our monthly subscription, which is our Plus plan. You also get access to all 8 of our trading rooms with our Plus plan. So there's some more information on that right here, right above the video. Down below, we invite you to engage with us on social media. Hit this little heart that opens up this new window. Hit that like button. Thumbs up here. Again, we benefit when you do that because the more likes and retweets our stuff has, the more people who follow us will see it. Because you don't see all the content of all the accounts you follow, only the ones you engage with the most. And that has engaged the stuff that the content that has engaging content. So you benefit too for that very same reason too, that they will show you the content of the accounts that you engage with the most. We try to make it really easy for you to do that here. Alright, if you take a look at the weekly chart again, you can see the Hakinyashi. Look at that long lower shadow on the Hakinyashi. And keep in mind, where we're going to open up next week. We're going to have a really bearish candle next week too. Because if you look at, let's see, 33, 35, 31, and then the close is 30, 81, 87. We're going to open up at 3208.59. That's where next week's. That's right. 3208 is right in this area, right where that dotted line, the 23% retracement level is. And we're going to open, depending upon how we, how we do over the weekend. But if we open right now, we'd be right around 3,000 because that's where we close, by the, well, not here, but like I said, at after hours, SPY kept going up towards 300, so 3,000 on this. So really close to the 200-day moving average. So, which means we're going to have a pretty decently sized candle already. Whether or not we retest 28.55, which is another 100 points away, remains to be seen. But you can see we have a red arrow, and we are testing the 200-day moving average. The question is, will we get below it and stay below it? For us to get this death cross, we have to get below it and stay below it. You can see that's what happens in all these. When you get below and stay below, that's when you get the death cross environments. And that doesn't necessarily mean we're headed to bear market, because none of these did. It just means that it's going to take more time to get a new intermediate run. Like the next intermediate rally won't really begin until we get back up above 32.26. And I don't expect that's going to happen. Now that I expect more of a death cross to occur. Again, depending upon where we finish next week. If we finish below 38.86, then we finish down in this area. If we finish up above, then that's a different story. I mean, we could definitely finish up to 32.20, but still not necessarily. It will take a few weeks, even if we don't get a death cross environment like we did here, and we rallied up for a few weeks after that big bearish week. We still retested the lows, and I fully expect that we'll retest these lows again. Whether or not we get all the way to 28.50 or just down to 29.50, I fully expect that after a bounce into this Fibonacci resistance area now, that we will retest the low points, figure out, build in some volume in this area. You can see on SPY, on the Bollinger Bands, we're going to, and if you look a little bit further out on this, let me, well, you got the drawings there. So you can see how we, on the 5-year chart, this is where all the volume is. So there's a lot of volume here, and we really hit that big volume node. We're still up above the volume area, so we still have plenty of support down below us here. So it's going to be really hard to get going. And so what's going to end up happening is on the daily chart, we see we hit the point of control today. Lots of volume on the daily chart as well. We'll probably come up into this Fibonacci resistance area and build up some more volume in this spot and make the value area go up to the top, closer to this 23% line. So that when we do eventually bounce and break out, we'll be breaking out of the value area. We won't be so far up above it. Like right now, if we got back up to 340, we'd be back to being so far above the ground, the tightrope, that would be susceptible to this type of move again. We don't want that, right? We want to build a nice solid base that when we get up above, we don't break out. We can nice and slow and steady continue to trend higher, so we can get some good returns out of it. So that's the kind of move I expect will happen. So some ups and downs and filling out some volume in this area, moving the value area up, which is the 70%. And if it takes a few months, we'll get rid of a lot of this volume here and shift it higher, and that will make the value area go higher. That will set us up for a better breakout move than a V bottom would. A V bottom breakout back to the top will just set us right back up for the same type of declines, depending whatever the catalyst would be at that point, but it would set us up for this type of decline again. Let's take a look at the 3 green arrow chart here. Not surprising to see 3 red arrows, and again, I showed you before, just how bearish we are. If I were to go to a daily chart here, how far down below the 30-day moving average we got, and that was pretty significant. We got all the way down to almost 10% below the 30-day moving average. I mean, if you were to go back over time, that's a pretty significant number. I mean, it's here. Let's move this now to where are we at today? It's 9.25%. So I'm going to move this line. Sorry, not that one. Move this line down to minus 9.25. So that's where we're at right now. Essentially, you can see when we got this far below the 30-day moving average, we snapped back pretty sharply, because it's hard to stay that far below. Zoom in a little bit more, and then kind of come back out here. There's that December low point. You can see even over here we didn't get 10%. We only got 6% there. So you have to go back to some of these other periods of time. This is June of 2016, the Brexit move. We only got a few percentage points. Here we are, August of 2015, we got to 9% below, and we snapped back over the next few weeks off of that low point. This is the Ebola virus scare. We only are 4% below there. Come back to, this is still 13, so we have to go, this is November of 2012, 4%. So here is May of 2012, another period where we're pretty bearish. We only got about 5% below. So we have to go all the way back to August of 2011, where we went from 7 to 12.5% below. And again, if you look at the Hakinyashi, or the regular candles, that set the low point, and we snapped back over the next 1, 2, 3, 4, 5 days pretty sharply from 18 all the way up to 1200. That's a pretty big move in a short, that short amount of time. We retested the lows, we bounced back up. We retested the lows, we bounced back up. We retested the lows. I mean, that's the type of move I expect that we'll get now. So this is I expect a very, very similar move. However far we get, it's probably going to be up into this area. Probably the highest it will probably get is around 3150. But remember, we got up about right here in the overnight. But if we keep going up, over the next 3, 4, 5 days, and then we'll probably retest these lows, and then we'll just get the choppiness. It's a very, very similar. We've seen. I've talked to market scholars. We've seen this story before. It's just different characters and different details, but the reality is, the more the when we say the market's different this time, the reality is it never is. The story is always the same. The characters are different. The character this time is coronavirus. It's been trade war. It's been China. It's been credit downgrade. There's lots of different characters. But the reality, the story during this bullish run is you get a big sharp sell-off. That's not necessarily due to economic conditions. It's just due to whatever the headline is. And then we batter around for a while, figuring out the lows, and we turn into a new bullish trend out of it. And I expect the same thing to occur here as well. All right, now let's take a look at the intraday chart. And again, you can see just how wide the range is. We're looking at 40 points, 55 point range. 55 point range, right? 339.08 minus 285.54. Yeah, 53 point range out of 339.08. I mean, that's a 15%. The rubber band is stretched out 15%. 10% is kind of the magic number. So the fact that we're stretched out 15% is pretty significant. Remember, we got up to right about this 299 level right here, and there's very little volume above us. Really, the next layer of significant volume in the last 4 weeks is right here about 312. We're the middle of that. And again, probably the 60, we're probably not going to get above that one at the very, very best. This is probably our best case scenario to get back up to the 50% mark. And we'll fill in a bunch of volume down here. See, the value area is way up above us, which is, we're not going to be able, that's a big ceiling that's hard to break through. So that value area's got to shift its way down here. So that's why you're going to get some ups and downs as it shifts its way down here. Then you're going to be able to break out of it and get going to the upside and be that much more bullish. I mean, look, the point of control is still way up at 336. I mean, it's still way up near the highs. That's how significant and sharp this selling has been to the downside. If you look at the volume and trading ranges today, again, another 12-point day, very, very large ranges. We had a 14-point day yesterday, surrounded by a 7-point day, a 12-point day there, and a 12-point day there. So big, big ranges. The biggest volume of all was today, out of all week long, 385 million shares trading. Lots of money trading hands today. So a little bit of a capitulation type pattern there. When you look at the ATR to price, obviously they're hitting extremes. They're getting really, and that's another reason why I think we're getting into a death cross, because we're going to pass the 2% mark. We'd have to have really, really small range days over the next, because this is a 14-day ATR. So 1, 2, 3, 4, 5 of the days have been huge, and these weren't too small to begin with. We were pretty close to 1% and above already those 2 days. So we still got like all these really small days to replace with relatively large days. We're going to easily be above 2%, which again is typical of death cross environments. So that just means it's going to take a little bit longer for us to figure out this low point and get going again to the upside. Volume is really taking off too. This is a 20-day average, so it's going to take some time for that to. It's still going to be moving higher as well. If I were to zoom out so you can kind of see how significant this is, and this puts it into context. Again, here's all the 2%. Here's when you got above 2%, we got the death cross here, and here's where you got above 2% with the death crosses there, and these levels you came close to a death cross here, but we never did. So, and of course, market sentiment pullbacks when you're above 1.5%, and we're easily above that. So we're most likely going to have a death cross environment. The ATR is getting really, really big. Volume is going to end up here too. But you can see it, after a period of really high volumes and trading ranges, It takes a long time for these to come down, and during those times, that long period of time where it comes down, the market trends nicely to the upside. The other thing that really kind of stood out to me today about the type of low point we're setting is this VIX. So you can see the VIX ended up with a long upper shadow. I spent a lot of time on this today in my technical analysis class. We talked about how to trade and how to trade this short term, a potential low point today coming out of yesterday afternoon. So I spent a lot of time. If you're a market scholar, monthly subscriber or a premium subscriber, you get access to that class. It's already recorded and posted on the calendar. Just go to our trading rooms link on our main menu and go watch that recording. I spent quite a bit of time on the VIX today, but needless to say, long upper shadow on the daily chart, and we eventually ended up with a long upper shadow as well on the daily chart. There we go. You can see the long upper shadow there, and we've seen this type of move before. I've compared today's move on the VIX to some of these others. So big time move when we have these big spikes, and again getting above 125% is death cross signal as well. 115% is the market sentiment pullback. 125 is death cross. So we didn't get those over here. We did actually on this. We got to 120 right there, 120% on that one in August of 2015. So very significant moves to the upside. Hard for volatility to sustain itself that high unless we are in bear market mode, or specifically the end of a bear market mode, which we're not, because we haven't even started the bear market. So again, as we've seen before with these spikes, look for volatility of next week or two to come all the way back down here towards 20, which is a 50% drop. I wouldn't be surprised, and it doesn't mean that we won't bounce back up towards 30 on a retest, as you see, retest of these lows, but I fully expect that we'll drop back down in the next few weeks towards 20 very quickly. All right, so to summarize, obviously we had a really deep market sell-off this week, needless to say, but that I don't necessarily think that we're heading to bear market. In fact, I don't think there's a whole lot of downside risk left. At least that's sustainable, right? We might get a long lower shadow, but nothing that would be sustained. It'd be a quick little, if this wasn't a capitulation, that would be type of sell-off. And then now it's just ups and downs in this area towards the bottom end of this week's selling. That's what we expect to see over the next few weeks to probably the next couple of months before we really base enough to get going again to the upside. And I fully expect that we will get going again to the upside with a new long-term low point developing here. So what do you think? Do you agree with that assessment? Do you disagree? There's a link right there popping out in the top right corner of your screen. Hit that link. It opens up a poll. Hit either agree or disagree. If you click disagree, comment down below as to why. What are you seeing that's different than what we saw? What are you seeing? What charts or indicators do you see that suggests we've got a lot more downside left to go? Or that we're going to V-bottom right off of this sucker, and within another couple of weeks, we're right back up to all-time highs again. So if there's something that you're seeing that suggests that, let me know, or share with our community down below. All right, now let's talk about this week that was from a broader scale, from a broader asset management scale. So let's take a look at just this week here. Actually, let's go back to the last 7 days, because the last 2 days of last week were not bullish either, obviously. So we'll go back and include the 20th here. So this is the last 7 days. You can see we were down those 2 days too. We were already down, and risk appetite was up. Look at gold dropping along with the dollar. So kind of another sign that we might not be that bearish after all. Obviously bearish enough that we dropped 12, 15%, 14% over 7 days, but not as bad as we think it might be. Everything fell. All these international stocks fell. Crude oil also fell at 15%. If you recall, it was already falling, right? So crude oil peaked over here in January, and then especially over here around the 17th. This is when the coronavirus fears were kind of getting started, and we had a little sell-off, and we rallied, and crude oil didn't rally nearly as much, and bonds yields didn't rally nearly as much. We were really diverging here. Remember how, like, we've been talking about, like, loads of divergences during that period of time that we're setting up on the markets. Obviously, nobody knows that you're going to drop 14%, but you know, there's lots of divergences that were showing up there. But you can see over this period of time, crude oil was one big one. It just was already dropping so much, and stocks hadn't at all dropped very much. And obviously now down really from this peak, when things really peaked the next day here on 1/3, when crude oil really peaked, it's been pretty much a big downhill drop ever since. There we go, 26% decline and a 13% rally. And I've mentioned this before, and I'll bring it up again. You know, here the stock market peaked, yields peaked in October of 2018. Since then, you know, we've been, like, look at gold. Like, this is not a pattern of an excessively frothy, speculative, risk excessive market, right? Risk appetite market. This is actually more of a sign of a market that probably has been in a lot more of a recession than we probably think it has been. Equities have been doing, you know, most equities were pretty bullish. International equities and even small cap stocks. This is small cap index right here. You know, at this point where the S&P was up 15% above those October highs, these other indexes are only a couple of percent. And you can see now they're down well below those October highs, whereas S&P is still just a smidgen up above that October high point. But gold's up 30% since that October high point. You know, you can see we initially started with a decline. Gold's up, bonds are up 30%. Long-term bonds up. Real estate was up 25% until this little latest decline that it had. Crude oil was down 40% from those highs. That was a significant drop in commodities and yields, and so, like, again, this is not like, you don't look at, you know, this period, this chart here, and say we're about to head into recession. I mean, if you were to look at this chart not knowing what the S&P was doing, you would actually think that we were in recession, right? If you go back to the last few recessions that we had, here's the 08-09 recession, right? So that's what that, I mean, from here to here, that's the recession. That's the end of the recession. Very similar to what we're seeing here. That was the end of the recession. In 2010-11, you know, things got really bad with the credit downgrade and Europe breaking up, and then the market really took off with QE3, and then just kept going up here. And we had a period of time in 15 and 16, beginning of 16, where yields really dropped. Then the market took off during that period of time. And then here was a recession over here, the 01-02 into the beginning of 03 recession. And again, you can see it never really even got this bad, but look at all that pink shading, you know, and then the market took off from there. The market didn't start the recession at that point, which would be here, right? The market's not going to start a recession here with already low yields. It starts a recession when we have really high yields and really high commodity prices, really high inflation that causes the Fed to raise interest rates, and that's, you know, and before that can even happen, the long-term yields will rise up faster than the short-term yields will. So you'll see this really, long-term yields really take off before the short-term yields will rise with the Fed raising interest rates to combat that inflation, and then eventually those short-term yields will catch up to those rising long-term yields. You'll get the yield curve inversion, and that's usually what precedes the recessions. And obviously, nothing even close to that. In fact, we're a lot more closer to the beginning of a big long-term move than I would have ever imagined back here, back at the end of 2018, October of 18, when at that point risk asset classes were excessively bullish. You know, again, going from July, and I think I showed this to you yesterday, but going from that's kind of a similar period, not yesterday, but Wednesday. But going from a similar period here, but going from July, like mid-July of 2016 to that October high point in 2018, so it's kind of a similar period of time going into October the 3rd, as we just saw coming out of it, where we saw those big 30% returns. Well, here's that same period of time going into it, and you can see very bull. I mean, that's more of an expectation that we could be heading into a recession. Very bullish risk asset class moves, and then oversold safety trade. That would be more concerning about a recession, and that did. I mean, that's what we looked like going into the October peak, and from that October peak, these safety trades have been up 30% ever since, and S&P is only up 2%. And these are all down. Crude oil is down 30-40%. So much different story. And so again, like I said, a lot more indicative of what could potentially be a really, really bullish move as the safety trade unwinds. I mean, we saw how bullish 2019 was. Here, this bullish move that we saw here this last intermediate run since October, when that safety trade started to unwind. Here, so go to October the 3rd of 18 again, and then to today. So today, so right here, from this point in September, when the safety trade started to unwind, stocks took off. They took off. We had a really good run in a short amount of time. That's the safety trade unwinding, and now the safety trade's even more overbought than it was over here. So I mean, not that I think we're going to like spike up to the upside anytime soon, but once we do figure out this base, then I think there's a good opportunity for us to be pretty bullish for quite a while going forward from here. All right, if you take a look at the sector rotation, you can see, obviously you can see what's been going on, but let's just look at just today alone, and this is just how bullish we are. And in fact, no, not today alone, sorry, this 7-day period where we've had the sell-off. Look how broad it's been. I mean, not even the safety sectors were immune. Like utilities was down, staples was down, healthcare was down, real estate, all of them down, almost as much as all these other cyclical areas were. And then you can see us bouncing up here. So, I mean, this was a broad risk off. I mean, they were holding up for a good chunk of the week, and then here, yesterday into this morning, everything sold off. And Poor Energy just has got the biggest sell. I mean, it's down 20% from that peak into now, and these are only down 5 or 6% when the market was down 10. But again, they eventually fell 10-12% while the market was down 15. And of course, we're rallying here. So, again, very capitulative when you see everything drop as much as it's dropped, and now you'll see everything bounce. I mean, obviously, we'll flip-flop these, and you'll see financials and technology flip-flop to the top and these to the bottom, but they'll all go up as we rally to the upside. Let's look at the 12 grid, and you see a bloodbath here on the 12 grid for all the U.S. sectors. Everything is dark pink shading and red line now. Now, lots of oversold clusters, but look at all these open candles that we got, and bullish candles in technology and communication services, lower shadows on these safety trades. So pretty bullish, but everything, like when you're 100% correlated, pretty much like we are here. Look at all their intermediate lines except for the safeties. Utilities and real estate are in the 30s. Everything else is like in the 10s and 5s. Like they're all showing the same pattern. That's a good sign too that we're getting. I mean, usually it takes a while to get to that point. It just took 5-6 days to get to that point here, but that's a good sign of at least a short-term bottom as well. All right, so for our trade idea of the day, I wanted to stay kind of in this bearish mode. Obviously, a stock like Cisco, for example, very bearish, bouncing up here, but you can see how dark pink shading and red line, and you can see the 3 green arrows look really bearish too, and we're really heading lower. The MACD's headed lower, stochastics. And you can see this is not very uncommon for Cisco to have, as bearish as we were. We were just this way coming out of earnings last August. So, and it kind of set the low point. But that's kind of what stands out to me here from some of these other stocks is Cisco is already in a death cross environment. We failed at the 200-day moving average and rolled over. That's not a good sign for the company. And then you look at like its Bollinger Bands, and you can see that, on the 1-year chart, obviously we're down below the point of control, and we're below the value area too, so that's not a good sign. But look at the 5-year chart for Cisco, and you can see the gap of volume until you get to 35, and really below that is where the next layer of significant support is. That's really bearish. I mean, we might bounce back up in the very short term up to 42, 42 and a half, maybe 43. But the reality is we are in a very big gap of volume that's going to be easy to fill to the downside on a stock like this. So what we wanted to do was do a bearish trade where we can take advantage of that move to the downside with a little bit bigger position than what I've normally done. The reason being is I can keep my losses smaller as we move to the upside. That purple line here. You know, there's a good chance I might not that I wouldn't take the full maximum loss because I got a big resistance, lot of volume resistance here. So I can keep my loss to $500, which is normal, half of my normal, but then I get a good $1,700, $1,800 reward with a relatively high probability because the peak is easily within 1 standard deviation. So there's a good chance for a pretty decent reward, a directional reward, with a relatively high probability of getting it on this trade. So essentially buying a put, 37.5 put for $1.79, but selling a 35 put, capping off my gains, selling that put to cover the costs, most of the costs. I still have to pay about 71 cents, so times 10 contracts. But you know, again, I still get a good reward for that really small risk that I'm taking to get into this directional trade. Well, all right, that does it for today. As always, you've heard from me now. Now I want to hear from you. Use that link right there. It's popping out in the top right corner of your screen. It takes you to our Market Outlook forums at marketscholars.com. One of the things you get for free when you subscribe, as I showed you earlier in the video. But post any questions or comments, and let's keep the conversation going in our community forums. What are you looking at? What are you seeing? How are you taking advantage of this move? What questions do you have about it? Is there something I didn't talk about that you had a question about? And post it in there. And of course, you can also reply to anybody else's threads too. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, and comment on our video down below. Follow me on Twitter for more content between the videos, and join our Facebook group as well as our website at marketscholars.com. Have a great rest of your weekend, everybody. We made it through a rough week. Next week, we'll see. Well, there might be some light at the end of this tunnel here. And we'll see how we go next week. So have a good one, and we'll see you all next time.